Over 40% of digital nomads are earning money through cryptocurrency right now, and almost all of them are accidentally playing tax roulette across multiple countries at the same time. If you're living the laptop lifestyle, hopping from Thailand to Portugal to Mexico, stacking sats between smoothie bowls, there's a very real chance you're creating tax problems that quietly follow you from airport to airport like a carry-on bag you can't get rid of. This isn't just about owing a little extra money. We're talking overlapping tax obligations, rules that change faster than your time zone, and penalties that can erase years of crypto gains in one extremely unfun audit. The good news is this isn't a doom story. There are completely legal ways digital nomads structure their crypto lives to reduce taxes, stay compliant, and still enjoy the freedom that made them nomads in the first place. Here's where things start getting weird. The moment you earn crypto while traveling, you step into a system that was designed for people who lived in one country, worked one job, and got paid in one currency. Crypto politely ignored all of that. Every trade, payment, swap, stake, or purchase with crypto can create a taxable event, even if no cash ever touches your bank account. Buy coffee with Bitcoin? That counts. Trade Ethereum for another token? That counts. Get paid in stablecoins for freelance work? Also counts. Now layer that on top of the fact that you might be subject to tax rules in your home country, the country you're currently staying in, and possibly countries where your business activity technically happens. Suddenly, your simple crypto income looks like a spreadsheet that never ends. One of the biggest traps nomads fall into is confusing physical travel with tax freedom. Leaving your home country does not automatically mean you've escaped its tax system. If you're a US citizen, the IRS wants a report of your worldwide income no matter where your passport gets stamped. Beach in Bali, cafe in Medellin, co-working space in Lisbon. The tax obligation doesn't care about the view. At the same time, other countries may decide you're their tax resident too. Many use the 183-day rule, but others look at where your money comes from, where you live most of the year, or where your center of life exists. It's entirely possible to be considered taxable in more than one place at the same time, which is the financial equivalent of being double-booked for 2 flights leaving at once. Crypto adds another layer of chaos because tax authorities still don't agree on how to treat it. Some see it as property, others treat it like income. A few are still squinting at it like it might disappear if they ignore it long enough. That uncertainty creates risk, but it also creates opportunity for people who plan carefully. A key difference comes down to how you interact with crypto. Someone constantly buying and selling tokens can be treated very differently from someone who mainly holds long-term and sells occasionally. The definitions vary by country, and choosing the wrong approach can quietly multiply your tax bill without you realizing it until it's too late. This is where geographic strategy enters the picture. Some countries have made deliberate decisions to attract crypto talent and capital. Portugal has offered favorable treatment for individual investors under certain conditions. Dubai operates without personal income tax. Singapore doesn't tax long-term capital gains for individuals. These aren't loopholes or hacks, they're policy choices. But showing up with a suitcase and a Wi-Fi password isn't enough. Tax residency usually requires proof that you actually moved your life. Bank accounts, housing, time spent in-country, business relationships, sometimes even community ties. Half committing is how people accidentally stay taxable everywhere instead of smartly taxable somewhere. Documentation is the quiet hero of this entire story. Crypto nomads don't get to be casual about records. Every transaction needs dates, values, purpose, and currency conversion at the time it happened. You also need proof of where you were physically located when those transactions occurred and documentation backing up your residency claims. This sounds intense because it is, but modern crypto tax software helps automate a lot of this chaos if you set it up early instead of panicking later. Some nomads take things further by earning crypto through companies instead of personally. Certain jurisdictions allow corporate structures that delay or reduce taxation until profits are distributed. Estonia's e-Residency program is popular because it lets founders manage companies remotely, while corporate tax is triggered only when profits are paid out. This can create flexibility, but it must be structured correctly or it backfires spectacularly. Then there's reporting, the part everyone hopes will magically go away. It doesn't. Even if your tax bill is low or zero, many countries still require disclosures. Miss them, and penalties can easily exceed whatever tax you would have owed. Crypto feels digital and invisible, but blockchain analysis tools have made it very traceable, especially once exchanges and wallets are involved. The smartest nomads aren't trying to disappear. They're building clarity. One primary tax home, clean records, professional advice that understands both international tax law and crypto mechanics. That combination turns a terrifying maze into something manageable. So if you're earning crypto while traveling the world, the real goal isn't zero taxes at any cost. The goal is intentional structure, knowing where you belong on paper, keeping your records airtight, and letting your money grow without future you getting a panic email from a tax authority you forgot existed. Because financial freedom feels a lot better when it doesn't come with a side of legal anxiety, no matter which country your laptop happens to be in this week.